In today's video, I'm going to talk about the important tax changes for 2024 and how it impacts your wallet and why you'll actually have less money in 2024 compared to 2023. I feel like we got a triple hit here, where wages remain low or stagnant, the cost of living keeps going up, and we get hit with more and more taxes each and every year. But it's not all doom and gloom, as I'm also going to talk about in this video where you can save money, where you can take advantage of taxes. So make sure you watch the entire thing to maximize your savings in 2024. And make sure you hit that like, subscribe, and thanks button on the bottom of this video so I know you want to see more content like this. So what's the big news for RRSPs in 2024? Well, the good thing is that the maximum contribution limit has gone up. It's now $31,560. That's an increase of about $800 versus last year. That means you can save more for retirement and reduce your taxable income all at the same time. That's a good thing. Now, this change is mainly beneficial for higher income earners because if you're in the upper tax brackets, this allows you to shelter more of your taxable income from immediate taxation, which is a good thing when it comes to your overall wealth creation. So for example, let's say you've made $100,000 in Ontario in 2024. With this maximum RRSP, you'll save about $10,000 in taxes. Now, if you've earned $150,000 and you take the maximum RRSP contribution, you're going to save around $14,000 in taxes. Moving on to the TFSA, the tax-free savings account, the contribution for 2024 has gone up as well. The contribution limit is now $7,000. This is one of the largest increases since its inception back in 2009. This is a major win here because this allows you to increase your tax-free savings and your tax-free investments and grow that income over time, all without paying any tax. The TFSA is one of the most versatile investment vehicles out there. I'm really excited about this TFSA increase. If you were 18 years old back in 2009, that means your lifetime contribution limit to the TFSA is now $95,000. That's almost $100,000 you can contribute and not pay any tax on the gains, on the interest, on the dividends. It's a major win and a major way to shelter taxes on your income. As you can see, I'm pretty excited about this change. It's amazing. So make sure you take advantage of your TFSA contribution limit in 2024. The First Home Savings Account, or the FHSA, is a special tax advantage account that helps you save for your first home. And here's the best way that I can explain what an FHSA is. Essentially, it seeks to take the best part of an RRSP, the best parts of a TFSA, and merge them together for first-time home buyers. And here's how it works. You can contribute up to $8,000 per year to your FHSA with a maximum lifetime contribution limit of $40,000. Your contributions are tax deductible just like the RRSP. That means you can lower your taxable income and save money on taxes at the same time. Your investments in the FHSA grow tax-free, which means you don't have to pay any tax on your investment income, whether that be interest, dividends, capital gains, it doesn't matter. It's tax-free. Now, when you are ready to buy your first home, you can take the money out of your FHSA tax-free so long as you use it to buy your first home. Now, since we are going into 2024, this will be the second year the FHSA has become available, and that means you can now contribute up to $16,000, assuming you have not used a 2023 room, because you are allowed to carry forward 1 year's worth of contribution room over to the next year. With the FHSA, you get $8,000 in 2024. With the TFSA, you can contribute $7,000 in 2024. And if we add in the maximum RSP contribution limit, which is $31,560, put it all together, and that effectively means you can carry up to $46,560 in 2024 and beyond tax-free on your investment incomes, and you only pay tax on withdrawals based on certain situations. With other taxes going up in 2024 and draining your wallet, you definitely want to take advantage of these tax-saving strategies. The first thing I want to explain when it comes to CPP changes is your yearly maximum pensionable earnings, or YMPE for short. Your YMPE is basically your limit that is used to calculate how much of your earnings you will contribute to the CPP each and every year. Your maximum pensionable earnings in 2024 will increase to $68,500. That's up from $66,600 in 2023. This means that you will be paying more into the CPP in 2024 versus 2023 and earlier years. Now, here's where things get a little bit more rough. there is now a second layer or an additional layer being added to the CPP, and this is called the second additional component, or CPP 2.0 for short. CPP 2.0 adds an additional layer to your pensionable earnings. This is called the YAMPE, which stands for Yearly Additional Maximum Pensionable Earnings. So what does all this additional CPP 2.0, what does all of this really mean for you, for your wallet, and what does it all boil down to? If you have earned up to the first layer of the YMPE, which has an annual limit of $68,500, that means from your paycheck throughout the year, you will end up paying or contributing up to $3,867.50 in CPP as a contribution as an employee. That means for every $1 you earn in 2024, 5.65% of that $1 from your paycheck will go to the CPP. Now, what happens if you make more than $68,500? That's when you move on to this YAMPE. Congratulations, you are now part of the CPP 2.0 club. Now, whether that's a good thing or a bad thing, well, that's up for debate. But what that means is that if you move on to the second layer, that means you'll pay an additional 4% of your earnings between $68,500 and $73,500. But that altogether, that means you could potentially end up paying in CPP up to $4,055.50 in 2024. If you were already feeling stretched on your paycheck in 2023, unfortunately, you're going to feel even more stretched in 2024 with the CPP increase and the CPP 2.0. It just means that more of your earnings are now going to the government as part of the CPP contribution. I'm really not a big fan of this increase, as it creates additional burden on employees who are already having a hard time making ends meet. For 2024, there will be adjustments to the federal income tax brackets. Now, this happens every year, so this is not really a new change, but for 2024, the rates, the income tax rates, are not changing. What's changing is the income thresholds for each bracket. What that really boils down to is that more of your income will be taxed at lower rates compared to 2023, potentially reducing your overall tax burden. So for example, if we take a look at the lowest tax bracket, which is taxed at 15% at the federal level, you are going to pay 15% in 2024 up to now $55,867. Compare that to the upper limit of the same tax bracket, which was $53,359 last year. And similar adjustments have been made to each subsequent bracket where the rates are not changing, but the income threshold has, which is actually beneficial to Canadians, as it allows you to keep more of your income before moving on to the next higher tax bracket. In 2024, the BPA, or the basic personal amount, is increasing to $15,705 compared to only $15,000 in 2023. What that effectively means is that now you can earn up to $15,705 and not pay any federal income tax. This is a good thing because it allows more of your income to fall into the tax-free range in 2024, and this is going to mainly benefit lower income earners. So for example, if you earn $30,000 in 2024, you will end up paying about $2,144 in federal income tax, compared to $2,250 you would have paid in 2023. So that means you are now saving about $106 in federal income taxes in 2024 compared to 2023. The CDCP, which stands for the Canada Dental Care Plan Benefit, is a new program that will provide dental coverage for households who have less than $90,000 and who are already not insured through their employer or through other means. Now, in order to qualify for the CDCP, you have to meet the following 5 criteria, so let's talk about what they are. First criteria is that you don't already have access to dental coverage, meaning you don't have insurance coverage from your employer, from your family member's employer, from your pension, or from your own purchase. The second criteria is that you have to have adjusted family net income of less than $90,000. The third criteria is that you have to be a Canadian resident for tax purposes, which essentially means is that you must live in Canada and have a social insurance number. Fourth criteria is that you have to have filed taxes in the previous year, and you have to apply into the program. It's not an automatic qualification. And the CDCP will provide dental coverage like cleaning, exams, x-rays. These are preventative dental services. You'll also get coverage for restorative services, which includes oral surgery, extraction. Essentially, these are treatments to fix or remove damaged teeth or decayed teeth, such as fillings, crowns, bridges, implants, etc. And lastly, the CDCP will pay up to 80% of the cost of these services, up to an annual maximum of $1,000. There are now new rules coming into 2024 for short-term rentals. And when I say short-term rentals, I'm talking about services like Airbnb. The change for 2024 is that you are not allowed any deductions on the income earned in prohibited areas. This rule essentially applies to cities like Toronto and Vancouver, where short-term rentals are restricted because of municipal laws. This rule is going to be a major impact to landlords who effectively rely on these short-term rentals to either avoid long-term tenants staying in their properties, and it's going to be a major hit to cash flows because a lot of the reasons you go into these rental property business is for the tax deductions on the income earned. What this effectively means for landlords in these cities is either now they have to either sell their rental property or consider other options like renting out their property for long-term tenants. This rule is a significant change in regulations, and it's all done to protect the housing inventory and to provide more long-term relief to our current housing crisis. Now, will this solve further housing crisis in Toronto and Vancouver? Probably not. But is this one step in the right direction? Yes, which should have been done a long time ago. Carbon tax, this is an often talked about issues. Let's talk about the two types of carbon tax you'll be paying in 2024. First, the federal carbon tax is going up. It's going up from $65 to $80 per ton in 2024, which, if you do the math, is now going to add 3.3 cents per liter to gas prices. And gas prices are already high as is, so get ready to pay an extra 3.3 cents. The second carbon tax is going to increase the price you pay at the pump by 17 cents by 2030. And considering we're already stepping into 2024, that's only 6 years away, and you're going to be paying an extra 17 cents in taxes per liter. So get ready to cough up about $1,200 per year because of this second carbon tax. So what is the purpose of this carbon tax and the second carbon tax? Well, the main purpose is to effectively reduce greenhouse gas emissions and to fight climate change. And what is the impact of these carbon taxes? Well, it will hit some people harder than it will hit others. And how much you get hit will really depend on where you live, what kind of car you drive, and how much you earn. Now, is this even effective? Well, your guess is as good as mine. So please let me know your thoughts on these carbon taxes in the comments down below. Is it effective? Or are you really going to feel the pinch this year, next year, and beyond? I really wish the Prime Minister would stop wasting money and actually give Canadians a break for once. Prescribed rates. These are essentially interest rates that apply to loans between family members or to overdue taxes. The CRA sets these rates on a quarterly basis based on market conditions. The prescribed rate to loans between family members is going up. It's going up from 5% to 6% in Q1 of 2024, which effectively means you'll have to pay more in interest from loans even if you're borrowing from family members. If you thought you can get away from paying lower rates if you borrow money from family versus a Type A, Type B lender, well, not really, because there are prescribed rates that apply to these loans. And the interest on overdue taxes is also going up from 9% to 10%, which means you'll have to pay more in penalties if you have not paid your taxes or if you are overdue in paying your taxes. The lifetime capital gains exemption. This is the amount of capital gains that you can exclude from your tax when you sell certain qualified property, such as shares of a small business corporation or a farm or a fishing property. And this lifetime limit is going up from $971,000 to now over $1 million in 2024, which means you can save more tax if you sell one of these qualified properties. The Canada Child Benefit, the CCB, and everyone loves the CCB, which is essentially free money from the government to help raise your family for children that are under the age of 18. And the good news is the CCB is going up in 2024 to reflect the cost of living. How much is it going up by? Well, the CCB is going up to now $7,787 per child under the age of 6. And for children between the ages of 6 and 17, the CCB maximum will be $6,570 per child, meaning you get more money from the government on a tax-free basis to support your children, to support your family in 2024. And at least that's a positive note. Thank you so much for watching. Hopefully you had some meaningful takeaways from this video. We've talked about where you're going to pay more in taxes, such as the CPP or the carbon tax. We've talked about where you can save on taxes, such as taking advantage of the increased contribution limits in the RRSP, the TFSA, and the First Home Savings Account. And if you're still unclear what this means, feel free to reach out directly. Feel free to leave your comments and your thoughts down below. And make sure you hit that like, subscribe, and thanks button again, because it lets me know you want to see more content like this. And make sure you please check out the links in the description, because it's another way for me to see your support for this channel and I can keep creating videos like this. That's it for now. I'll talk to you in the comment section.